Hello everybody, welcome to another video of Valuation Basics. Now today we are going to take something that is a little harder. Alright, we're going to discuss the cost of debt, which you see here, alongside a discussion of the yield curve. Now if you have not watched my video on bonds and you're not familiar with bonds, I recommend go back, watch that video first, and then you'll be able to understand what we are going to discuss in this video for cost of debt. So if you have not seen it, please stop the video here, go and watch bonds first. There's a video on bonds valuation that would be important. So assuming you have some background, let's go. My name is Irwin again, and I'm a lecturer for the SCA, Singapore Chartered Accountant qualification for the Business Value, Governance and Risk module. So in that module, we would always deal with the cost of debt. Now, how do we understand the cost of debt? In order to understand it, we have to be aware that one person's earning is another man's cost. Therefore, if we ask, what is the cost of debt to a company? The company's cost of debt can thus be seen as the return an investor derives. So, one man's return, the investor, is the company's cost of debt. One man's earning is another man's cost. Now, with that understanding, we can then find an investor's return on the bond using the IRR function. And if I know how much an investor earns, I would know then what is the cost of debt, right? So let's see how the IRR function works and how can we understand this better. Melissa, that is in the example, Melissa bought a bond at $97. It has a face value of 100 and pays annual coupons of 6%. So here, I think we will be aware, if you have watched the bonds video, you are familiar with bonds, the coupon, $6. The bond has 5 years left to maturity. If we need to put an end, it will be 5. What would be Melissa's internal rate of return? IRR. So, Melissa pays $97 for the bond. You can think of that as like the investment. So, Melissa has invested $97. What does she get back in return? Every year, she will get a coupon of $6. And not to forget, at the end of 5 years, you will get back not only $6 as the 5th year coupon, but you would also get back the face value of 100. And when you look at the 5th year cash flow here, you notice $6 plus $100 face value. In every other year, Melissa is getting $6 coupon, $6 coupon, $6 coupon, $6 coupon. So assuming she invested $97 at the start, what does she earn from all these cash flows? If I want to find a percentage to represent her earnings, how would I do it? I would use the internal rate of return function. And here is a screenshot from Excel actually, where you can easily just put out the cash flows and Excel will calculate for you the internal rate of return. Now, I want to show how it is done, and I will do it from scratch so that you yourself can follow along and replicate it, right, at your own free time. So I'm going to pull up Microsoft Excel, you see here. Whenever we have to calculate IRR, what we need is simply one column to say the period. Which period are we in? Are we period 0, period 1? And the next column would be the relevant cash flows. For cosmetic reasons, I'll just bold them and then I will centralize them. So, always remember to start with period 0. 0 is now, right? Then 1, 2, 3. In this case, there are 5 years to the bond. So 1, 2, 3, 4, 5. Let me bold all of them. Now, why must I start with year 0? Why must I start with now? In order to find your rate of return, you have to explain to Excel what investment you made. If you did not invest anything, then what rate of return? What return are we talking about? There's no return to speak of. So, what was the investment? In our question, $97. I had to buy the bond for $97. After that, I will get $6, $6, $6, $6 coupon. And in the last year, remember, $100 and $6 coupon. Okay, let me just unbold this. Now, this is my cash flow. In order to find the IRR, you don't really have to type IRR there. I'm just putting it for teaching purposes. What you need to do though is pull out an equal sign so that Excel knows you want to call a formula, and just call the formula IRR. Okay? Close it with a bracket and select within the brackets the cash flows that you are looking at. And next, all you need to do is press enter. Now, be careful of the decimal points. Sometimes Excel would just round it to 7%. But when we find IRR, we do wish to be a bit more precise. So you could always pull it up to 3 or 4 decimal points by pressing on the decimal points function. In here, 3 decimal points will do. And you get to see this is how we get 6.726%. Okay? Now let's do another question. Minimize my Excel. Let's do another question. And this time you'll see there is a tiny trick in this question. And we need to know how to accommodate for this trick using Microsoft Excel. So same thing, Melissa bought a bond at $97, face value of 100, but semi-annual coupons of 6% per annum, which means my coupon will be 6% divided by 2 semi-annual, right? The 6% was an annual rate, but we are paying semi-annual coupons. So 6% divided by 2, your coupons are 3%, namely $3. Okay? The bond has 3 years left to maturity. So 3 years, but we are going semi-annual, remember? So each year has 2 semi-annual periods. Therefore, 3 years times 2, 6 is my n. Now, what would be Melissa's IRR? Now, of course, we have the answer here, but let's do it ourselves, okay? Again, let's do it ourselves. So we'll pull up Microsoft Excel, and let me pull it to the side here, okay? Now, I'm just going to copy and paste if you don't mind. Alright, I would then later remove it. Okay, so I'll copy and paste it here. I'll remove all these cash flows because they may not be relevant. And let me just insert one row. Now, in our next IRR calculation, alright, same thing. Put down all the periods. I have 6 periods in my question, right? Let me just pull slightly more so you can see the n. The n is 6. My coupon is $3. We start off by saying how much we have to pay for the bond. I have to invest $97 to buy the bond, and in return, every period. Now, what is my period again? Remember, my period is semi-annual. So every period I get $3, $3, $3, $3, $3, and right at the end of the bond, $100 face value plus $3 coupon. And I then say, Excel, pull out the equal sign. Excel, find me IRR. Close the bracket, and within it, place the range of cash flows we are looking at. IRR is 3.564%. Now, question to consider. Why is the IRR so low? In our earlier question, the return the shareholder earned was 6.7%. But here, the return the shareholder is earning is more than what? Half gone? Actually, about 60% of it is gone. What is 3.564%? So much lower. About 60% lower. Okay? Oh, my mathematics is failing me. No, not 60% lower. Yeah, about 40% lower. Sorry. The inverse. I went to inverse it. About 40% lower. Okay? Why is it so? Right? Is this bond really less profitable? Why is the IRR, as the question says, so much lower than the earlier one? Because this is showing you the return per period. And remember, your period here is 6 months, semi-annual. Whereas above, it's also showing you the return per period, but this is for a 1-year period. So, if I want to really compare them, to make them apples to apples, I would have to do this. If I wish to analyze it, there are 2 ways to do it. I could do it the nominal method. The nominal way of analyzing something is just take 3.564% times 2. And if I times 2, I will get, give me a second, I must use my calculator, 7.128%. This would be annualized. From 6 months, you multiply by 2, you get it annual. Now, if you want the effective way, using compound interest, the effective rate, it would then be 1 plus 3.564%. And you have to put a square here because in 1 year there are 2 periods, so you put a 2 there. Okay? You put a number of periods within a year. 2. That is how you annualize it. Okay? And you just place a simple minus 1 at the end. So you do it like this. Okay? 1.03564 square minus 1. Answer is 7.255%. Okay, so this is how we annualize it, and this is how we find the IRR. And remember, do not get lost into, oh, we are just finding IRR and all. What is our objective again of IRR? If I know the return of an investor's return, which is someone's earning, is the company's cost, right, of debt. So, if you ask me what is the company's cost of debt, I would tell you it would either be annualized 7.128%, that's the nominal rate, or the effective rate, it would be 7.255%. That is the company's cost of debt. Now, bear in mind, I'm just teaching the basics. So herein, I have excluded tax. Tax changes things. But we will discuss that in our face-to-face classes, alright? Here, let's take it without tax, simplify it. This is the basic. This is the basic that I need you to know. Now let's move on. So we are done with IRR. Now, let's look at the question first before we pay attention to the header of the yield curve. Then it says, what if we need to find the cost of debt for a new bond that has not been released to the market? Okay, so this new bond has not been released. Nobody has bought it yet. It is in the works, maybe it's still under planning. Alright, we're going to release it soon, but it's still under planning, it's still in the works. Why would IRR not help me find the cost of debt for a new bond? Why? Why can't I just use IRR and stop the lecture here? Because if you recall your IRR calculations, IRR always needs you to right? Okay? IRR, do you recall, in year 0, you must always put the cost of the bond. How much you bought the bond for in year 0. You have to buy it at a certain price. Then IRR will tell you what the return on your investment is. But fellows, this bond is not even released. How would I know the price of a bond that has not been released? There is no price. Therefore, IRR will not function. Right? There is no price. Now, in that case, then, how do we solve something like this? This is a pertinent question for companies that are planning to issue bonds to the public, right? So they have to think, what is my cost? So how would they do that? Here is where the header comes in. Remember the header said yield curve? Now, the yield curve will show you the return expected on bonds that are having different maturity dates. So the yield curve is a piece of market information. It shows you what the market is expecting for their returns. So if I'm an investor in the market, I would show through the yield curve what I expect as my return if you make me wait for 1 year. Example, if you make me wait for 1 year, I might wish for 3% per year as my return. If you make me wait for 2 years, the yield curve will also show what the investor demands. If you make me wait for 2 years, maybe I will demand a bit more. I will want 3.5% per annum because you're making me wait longer. So I want a higher return to compensate for that. Okay? So a yield curve basically shows a certain return for a certain time period, a certain return for a certain time period. Alright? Now, often at times, in our module SCAQ BG, the yield curve will be the return not for corporate bonds, not for a Google bond or a Facebook bond, but it will be a yield curve for Treasury bills. Alright? Whenever it's a yield curve for Treasury bills represent a risk-free rate. And normally the exam will say, this is the yield curve, find the relevant cost of debt for the company. The company. Now people, if my yield curve is the risk-free rate, that is a slight problem because my company, my corporate bond, is not risk-free. So what I would then have to do is I have to add a credit spread to the risk-free rate. Okay? We will examine this concept in the examples coming up. So here, example, Freshco wishes to issue a new 3-year bond with a face value of $100 and a 5% coupon. Freshco has a credit rating of AA. This shows the risk level of Freshco. Alright? And from that risk level, I can then tell the credit spread. Okay? So Freshco has a credit rating of AA. It is wishing to understand the desired return of investors. So, for investors to buy AA rated bonds, how much are they demanding? What return do they want? When Freshco knows their return, Freshco can decide on the price to sell the bond. You must sell it at a price where investors are happy to buy. In order to make them happy and willing to buy, you need to find out how much they want to earn, right? What is their desired return? So this is how a company deals with a new bond. Now, the following tables are provided for yield curve and credit spreads. So, in my yield curve, Treasury yield curve, if you make someone wait for 1 year for his money, he wants to earn this amount. If you make the person wait 2 years for his money, he wants this amount. Wait 3 years for his money, he wants this amount. Now, this is the Treasury yield curve though, which represents the risk-free rate. Freshco is not a governmental organization. It is a normal company. It is not risk-free. It has a chance of bankruptcy, right? And here we see its credit rating is AA. Now, a credit spread is simply reflecting the extra risk a company has over the risk-free rate. Okay, so compared to the risk-free rate or a risk-free entity, how much extra risk do you have? So if the government, its risk-free rate is here, let's say 3%, how much more risky is Freshco compared to the government? Now, if Freshco is riskier to this amount, then I would then add a credit spread. So since you are riskier by this amount, I would want to charge you for that extra risk. And here, your credit spread might work out to be, for example, let's put a small amount, 0.4%. So the total you have to consider then as your cost of debt will be 3.4%. Alright, so here we are going to see Freshco is an AA company. The credit spread, 30 basis points for the 1 year, 37 basis points for the 2 year, and 50 basis points for the 3 year rate. Now, folks, we have to match the rates. The 1 year is matched to the Treasury yield curve 1 year. The 2 year to the 2 year, and without making a mess, I'll just only draw the 3 year. The 3 year credit spread is to the 3 year yield curve. So, how do we use this? They say, what would be the cost of debt and what would be the price of the bond? So, follow along. It may seem a bit confusing, but I'll explain it after the workings are done once more. Alright, so in here, to value the bond, I will put my period, I'll put my cash flows. So, in here, we do not have the price, so we do not need to put period 0. We are valuing the bond, so we can start off with period 1. Period 1, this bond is a 5% coupon bond. So, the coupon, I'm sure all of us now, we can see will be $5. 5% times $100 face value, right? So, in period 1, I will get $5. Period 2, I will get $5 again. Period 3, I will get 105. 100 plus 5. Now, these are my cash flows. What would be the cost of debt for each period? Each period's cost of debt. People, cost of debt can be represented by KD, okay? KD is short form for cost of debt. So what is each period's cost of debt? Now, if you make someone wait 1 year for the money, which is this, right? This $5 here will come in period 1. You are making the investor wait 1 year to receive his $5 coupon. If you do so, what would the investor expect? He would want to earn 3.48%, which is the risk-free. But remember, you are not the government. You are not risk-free. He's going to say risk-free plus credit spread. Right? So the credit spread for 1 year for a double A is 30 basis points. This works out to be 0.3%. So the cost of debt for period 1 will be 3.78%. Now for year 2, you are making him wait 2 years for the next $5 payment. Right? From the standpoint of now, okay? From the standpoint of now, he waits 1 year for the first payment, and for the second payment, from the standpoint of now, he waits 2 years. So what would he want to charge for this that he's waiting 2 years for? Yield curve 4.76% plus credit spread 0.37%. Okay? And this, I don't trust my mental calculations, not when I'm shooting a video. Alright? 5.13% is the answer. And I think we got the hang of it. If I asked you to do year 3, surely you would have not much issue. You would pick the 5.45% here. You would pick the credit spread of 50 basis points here. And you'll be at 5.95%. Alright? Now, with this, I can then use the time value of money, I would put my discount rate and I will get the present value later, and the total present value of the bond is its price. So let's see how this all works out. Now the discount rate would be the cost of debt. Remember, your discount rate really is just 1 plus R power minus N, right? So R would be your rate of return, your cost of debt. They are the same thing. So I'll just take the total amount here. This is my cost of debt. 3.78% power minus 1. So I'll take the $5 and I will discount using this rate. Okay, so $5 times 1.0378 power minus 1, get the answer 4.82. Don't mind, I'll just round it to 2 decimal places. Now for the next discount rate will be 1 plus 5.13% power minus 2. So $5 times 1.0513 power minus 2, 4.52. And finally, 105, I would discount it with, this is a year 3 cash flow, right? So discount it over 3 periods. Yeah. I would then get 88.28. And if I add them all up together, I would land with 97.62 as the price of the bond, as the value of the bond. Okay, so the price of the new bond, 97.62. If my boss asks me, what is the cost of debt? I would have to say, boss, I can't give you a single number, but I can give you on a year-by-year basis. If we are talking about the first cash flow, where the investor has to wait 1 year, the investor, for waiting 1 year, he will demand to earn 3.78%. That will be his cost of debt. Alright? For the second cash flow, which the investor has to wait 2 years to get, boss, my CEO, my dear CEO, the investor is telling us he wants 5.13%. Okay, that is what he wants as his return, and that will be our cost of debt as the company. And boss, for the final payment, you know it's going to come in year 3, so the investor has to wait 3 years for the final payment. Boss, for that, he wants 5.95%. Okay, I can give you a year-by-year cost of debt. Okay, so here is each period's KD. Now, I have answered his question. He asked me what would be the cost of debt and the price of the bond. I actually have answered him. But if you were a boss, different rates for different time intervals. Now, that doesn't sound easy. That doesn't sound easy to comprehend and make a decision. So what our boss may tell us then is this. Okay? He may ask, I'm really confused, right, by how each year has a slightly different cost. Is it possible to give me just an overall rate to reflect the cost of debt for this 3 years bond? Don't give me 1 year, one rate, like year 2, another rate, year 3, another rate. No. Can you just give me one rate for me to wrap my mind around the bond? Just one rate. What is the cost of debt for this bond? Now, people, are we able to do that? Congratulations, yes we are, because what we're going to do is we're going to realize now I have the price of my bond. What is the price of my bond again? 97.62. So, price of my bond, 97.62. People, we know the coupon. The coupon was already calculated earlier. We know it's $5. My N is 3. Guys, am I able to find an overall rate to capture this whole bond? Yes. I will just use IRR. Okay? I will just use IRR. IRR gives you an overall rate. Why couldn't we use it earlier? Because we did not have the price of the bond. But now I have the price of the bond. I can use IRR to find the overall cost of debt for this bond. So let's go ahead and let's work that out. So I'm going to pull my Excel back in again. So you'll notice now, let me just copy and paste it, okay? Let me copy and paste below here. Okay, so you scroll down below. I do not need so many periods, so I'll delete this off. I only need 3 periods for this bond. I'll delete this, I'll delete this. Now, this period or this bond has 3 periods. How much do you buy the bond for? The price is 97.62. What will you get once you invest 97.62? Once you invest and you have bought the bond, what you will get? $5 coupon. $5 coupon at the end of the year or at the end of 3 years, 105. Right? $100 plus 5. And here I have all my cash flows. Same thing. Let's call up IRR. And this is my IRR. This is my cost of debt. IRR equal to 5.89%. Okay? If you wish, I will just flash this for a while. Okay, you can always refer to this part of the video again, of course. But this was how it was done via IRR. And I can now present to my CEO a single rate. My cost of debt then is 5.9%. This captures the entirety of the bond. Alright? Now, sometimes our module, SCA BG, will simplify this whole process by just giving you an overall treasury yield and an overall credit spread. Now, what do I mean by that? Look here. Freshco wishes to issue a new 3-year bond and has a AA rating. The yield for a 3-year treasury bond is 4%. So they have just told you a similar bond, the risk-free rate, similar only in the sense that it's 3 years. The risk-free rate for 3 years is 4%. And a credit spread for AA bonds is 180 basis points. People, what is the cost of that? If they simplify it down to this for you, they have given you the overall yield and the overall credit spread. Alright? They do not want you to work out year by year by year. They just give it to you like this. Then congratulations, just thank them for being so kind to us. Our cost of debt will really just be our risk-free rate plus our credit spread. So the risk-free rate plus the credit spread. So here, my risk-free is 4, my credit spread is 1.8%. The 180 basis points is 1.8%. 5.8%, this is my answer. Okay? So in here, we get the concept. Your cost of debt will be your risk-free rate plus your credit spread. So whenever there is a yield curve, we would have to think of this concept. My cost of debt, use the yield curve to find the risk-free rate, add on a credit spread to it, and you have got gain, you have got your cost of debt. Okay? So I hope you have enjoyed this video. Do drop me an email if you have any questions on this video, or you could put it in the comments down below. If you wish to link up with me, sure, this is my QR code for LinkedIn. And you could always drop me a personal email at my address irwin.luo@learningluminarium.com. So thank you once again for joining me in this video. Yield curve is something that is important. Many find it difficult. So if you couldn't really get that idea on yield curve, please invest the time, go back and watch it again. Just that yield curve portion. And you could read around it by doing more research, some web research. Just Google yield curve. Tons of articles out there. So thank you once again. My name is Irwin, and thank you for joining me for this video.